downside, are pulling down the downside. Power Grid, M&M is again down 1%. That's interesting. M&M is now again the biggest Nifty loser this morning as well. There's BPCL, there is Bajaj Finserv, there's Ultratech Cement, Titan is a little weak, ONGC is a little down. No trends really, it's all over the place. The only interesting stock is Mahindra & Mahindra. That's follow through selling, second day running. And on the upside, there is Bharti Airtel after that block. It's up and about 1% higher. And that's about it. There's a bit of obviously a defensive color to the market. So Wipro, Apollo Hospitals, Cipla, Sun Pharma, these are your names. The banks are sitting on the fence right now. Axis around 0.25% higher, ICICI at the flat line. So let's see. Bank Nifty is very, very quiet. I'll just end up with HDFC Bank, which is also very flat. No clear trends on the Nifty. Watch out for the selling on Mahindra & Mahindra. Guys?
Well, one stock from the broader markets that's taking it hard is Borosil. The stock is down close to around 15%, 18% I think. So just keep an eye out on that one. I'm not sure whether it's numbers or something else that came about on that one. But volume's fairly high. That's down. The other couple of names that are lower, Best Agro, that's another stock that's down close to around 8%. Techno Electric is down close to around 7%. Volume's decent on all these names. And Zen Technology has said that all is well and they're expecting things to improve from here on, and they're expecting that 900 crores of a revenue target that they'd given earlier this year. But that stock is down another 5%. A few stocks that are doing well, TVS Supply Chain, that stock is up close to around 5%. Volume's fairly decent out there. Borosil Renewables, that is up close to around 5%. So both of them going in opposite directions, and we'll have the management of Borosil Renewables in the next hour or so on Chartbusters to detail their numbers. All cargo terminals as well has opened up well in the green. So the start is more or less flattish on the headline index, but a lot of stocks actually are moving around, and some of them in terms of the top volume movers today. Zen Technology tops the list. RVNL is a little bit lower. Z Entertainment, that's up close to around 1.5% to around 2%. And I think Piramal Pharma as well, another one that's a little bit higher. Mangalam?
I'm looking at ABB India. We looked at the stock, at pre-open as well, up around 3.5–4%. Right now, holding with gains of about 3%. Interestingly, Max Healthcare, which was holding well in pre-open and opened well as well, has seen some sell-off from the highs. Currently back in the red. Persistent Systems and a couple of these mid-cap IT names doing extremely well. Persistent Systems is one of them. First Source is the other one. Both of them seeing some traction. Siemens on the back of perhaps ABB or not. Maybe, some of these CapEx names doing relatively better. Varun Beverages is the other one that I'm looking at as well, up around 1.5% at the open itself. I'm just trying to see what, some of these brewery names are doing. United Breweries is up around 0.5%. Remember, the company was, sanguine on the prospects of demand going forward, with EBITDA margins seeing some bit of recovery, largely on account of the price action that took place in Telangana. So whether that continues or not is something we will most definitely keep an eye out on. AB Fashion and Retail is the other one, which continues to gain after a decent set of their third quarter numbers. So ABI Fashion and Retail holding with a gain of about 0.5%. But right now, as we speak, all the frontline indices firmly in the red. The mid-cap index by a smidge, the Nifty Bank by 0.25%, the Nifty and the Sensex by about 1/5%.
A couple of textile/apparel stocks are looking up. So there is, I saw Gokuldas Exports flash by somewhere, was 5% higher. There's Raymond Lifestyle, which is up about 4% as well. And Trent in the pre-open was up. I don't know if we can get Trent up on the screen again. No, not Trent, Trident, beg your pardon. Yeah, that's Trent. Trident is the stock that I was, looking out for. So some of these stocks are a little bit of green. We'll actually discuss this in more detail. A lot of them are export-oriented companies, large exporters. What lies ahead for them if we're getting into these big tariff negotiations with the US? But that later. Right now, we get into the market conversation. Our market master of the day is Krishna Sanghvi, Chief Investment Officer, Equities at Mahindra Manulife Investment Management. Krishna, thank you very much for joining in. Welcome to the show. And it's been a tough last couple of weeks and months, right? The simple question to you to start off with, do you think the market is in the process of making some sort of a bottom? Or would that be, too much of conjecture at this point in time? What's your sense?
Yeah, I think it's too early to judge, because let's look at the dynamics of market first playing out really, right? We're looking at a large amount of selling by foreign investors, as well as large amount of money raised by listed companies or maybe to be listed companies via IPOs. So somewhere that supply dynamics of the market has taken a change vis-a-vis what we were used to in last maybe overall 2 years period. If you look at, last 4 months have undergone this change, and we need to worry about that from a market dynamics perspective. I think as far as economy is concerned, reasonably on track, that 6.5% GDP. Yeah, we were possibly we going to clock a bit lower than what the number was at the beginning of the year in terms of FY25. But some of those, deviations are likely in this geopolitics world where too many things happening outside India, outside our own comfort zone. Plus, some marginal hits and misses on companies. So I think the real challenge in last 4 months period for market has been, how the supply side of the market has caught up vis-a-vis, the demand. So we not really sure in terms of, how that incremental selling can happen, because especially for FPIs, they do look at India as one of the countries to invest. They have their own, opportunities or options to evaluate vis-a-vis some other emerging markets or even some developed markets also.
All right. Hi, Krishna. Good morning and good to see you. But Krishna, do you think that we are closer to the bottom? There was exuberance that played out. That's why we went dancing away, both the headline index and the broader markets as well. But do you think, going by the RBI action, the government as well, they've laid out a good outline with regard to the consumption picking up in the second half of the year. Capex is picking up on ground. And these are various indicators that indicate that the economy is doing okay. The markets are, in a bit of a flux. So do you think, putting all this in the backdrop, do you think we're closer to the bottom on the headline index that's on the Nifty? Would that be fair to say?
Yeah, it'll be fair to say, because if you look at markets, whatever concerns of valuations were there were more in the the larger market, like small cap, mid cap indices had these challenges of valuations. I think on a large index, Nifty, reasonably comfort on valuation front, plus all those factors you mentioned, economy on a better track, especially the December GST collection was pretty good at double digit collection growth we saw for quite some time. So yeah, macroeconomy angle, things looks okay. The government policies in place, RBI policy also has changed the dynamics in terms of giving a lower rate environment we've started. So that way looks good, yes.
Good, but as we speak, currently at the low point of trade for the frontline indices, the Nifty below that 22,900 mark, and it's been led lower by a couple of these, a lot of the domestic facing names itself. We have Grasim, which is at the low point of trade. We have Shriram Finance lower as well, BPCL lower, ONGC, Bharti, Airtel. After that up move that we saw at the open itself, that's been sold into, currently at the low point of trade. And we are seeing some declines in a couple of these auto names like Hero Moto and Eicher Motors too. On the way up, however, some support coming in from IT. LTI Mindtree has moved to the high point of trade. Tech Mahindra is doing well, as is HCL Tech. So the IT index comes up for you, the Nifty IT. That's telling you that there is some support coming in from that part of the market. M&M, interesting, very, very interesting, was down 4% in yesterday's trading session, opened as the top Nifty loser. That dip has now been bought into, and the stock is marginally in the green. Krishna, you did say that maybe, at the headline index, we seem to have made a bit of a bottom. But going forward, if you had to deploy fresh capital, what sectors would you deploy it in? Where have the valuations become a lot more reasonable vis-a-vis expectations? And where do you think there is a better chance of you outperforming, the market over the next 1 year itself? And where would you pull out your money from?
Yeah. Yes, I think, in the context of valuations, over and above the sectoral dynamics, I think one needs to be slightly more, receptive to the fact that across all sectors, the large caps are more attractively valued vis-a-vis the mid and small of the same sector. So, it's going to be a little bit a combination between sectors on one face, as well as, the large cap versus mid and small. And that has been the case, right? Even in CY24 or maybe quite a bit part of CY23, we had this, situation where large caps as a category would have underperformed across the sectors vis-a-vis their own peers in those sectors. So I think it's a little bit reversal of that large cap versus mid and small trade. Coming to sectors, clearly today, financials looks interesting category from a valuation front. We are possibly at the bottom in terms of what we've seen historically on financials. Earning growth is on track. Even last quarter or so, financials continue to report a nice earning growth. In fact, if you look at quarterly, financials are almost 40% of NSE 500 profits. So it's a large, profit surprise or profit growth coming from that segment. Financials are interesting. Yeah, consumers can be a nice sweet spot for, lot of volume growth, stroke profitability growth, because post budget, that a large number of 80,000 crores to 1 lakh crores range for tax saving by individuals, which can flow into consumption related activities. So those two looks a good spot. I think IT pharma has their own challenges, partly emanating from outside India in terms of what can happen to tariffs. So it's slightly difficult to gauge any policy action coming from US on tariff front. So no clearly view right now. Let's wait for a month or so for US to really spell out what they're looking to do on tariff front.
Okay. By the way, the news from the screen is not very promising. Look at the mid-cap index already. It's down about 0.7%. There's a familiar pattern that we open and then the drift down starts. Even the Nifty is now down 60, 65 odd points. And I just want to point out one more thing. The VIX has been moving higher the last couple of days. The VIX has now crossed 16. I mean, it's still not at the high seen just before the budget. That's when the VIX had really spiked because of volatility, pre-budget volatility. It moved up to almost 18. But nonetheless, and this is a big move. I mean, this is just today we're talking about 16 on the India VIX.
And this is after all the major events are out of the way.
Yeah.
That is something that is a lot more, noteworthy than had the VIX been rising ahead of the RBI policy meet or the budget or maybe Modi-Trump, tariff sort of meet.
And one more point, in yesterday's trading session, we ended high with a gain of around 30-40 points, but the VIX moved up. That's normally not something that normally happens, right? You normally see the VIX move in an inverse relation with the Nifty move, but that's precisely what's happened. But 50-point downtick on the Nifty, you'll take that. Some kind of consolidation. I'm keeping an eye out actually on the number of stocks advancing. It's still closer to around 900, 950 stocks. You want to end somewhere in this vicinity, because in the past we have seen that number, once it slips drastically. Even 750 stocks as we speak.
I thought you were going to say you're watching out for 22,800, whether it'll be, now quadruple is done. Now what, penta, some bottom, I don't know.
We'll get that.
Just as you spoke about that, 900 stocks advancing, just
750.
It became 750. So that's the ferocity with which the market is declining. Though HDFC Bank has continued to hold well. It did recover from the lows and currently holding in the green. Yesterday it was HDFC Bank and Reliance, both of them led the recovery. Reliance isn't falling much, down about 1/3%. HDFC Bank is actually at the higher end of today's limited trading range so far. So those are a couple of things that we'll keep an eye out on too.
By the way, just pointing out, ACC, Grasim, a couple of these stocks are down quite a bit. Borosil, Nigel had spotted early in the morning itself. It's about 12% lower. The company posted the transcript of its investor call on the exchanges last evening. Maybe there's something that the street didn't quite like over there. We'll get more details on it in a bit. But anyway, in general, there is a bit of a mid-cap unwinding that's already underway this morning. Krishna, and that's the question, this whole mid-cap pain. And it's not institutional. It's not just the FPI selling. When FPI sell, larger stocks fall. And domestic institutions have been still net buyers, and their patience and faith is really getting tested. What do you make of this whole mid-cap unwinding that's going on? And what's the buzz that you pick up from the street? I mean, is this because of sell orders from large HNIs? Is it, direct retail? How much is it, margin issues that are playing out? What are you picking up?
Yeah, I think there will be always those kind of, dynamics which might play out on either margin or some selling. But I think let's look at a big picture again, simple. The continuous selling by FPIs have made, large caps far more attractive. So even from a domestic portfolio manager looking at, with a flexible mandates like a flexi cap or a focus or a funds, where fund manager actually have a mandate to increase their large cap allocations materially vis-a-vis what, they were running in the past. I think it really makes sense to do some sort of a tilt in the portfolio, because, finally valuations is what, we should look at as an investor, and large caps are becoming attractive mainly because there's this, continuous selling by FIs.
Right, and you said that large caps look a lot better than mid caps. That was earlier the reverse case, where in a particular sector, the second or third rung players would do a lot better. So do you bet now on the return of quality? And if yes, then in that as well, what are the sectors that are best placed? You like financials, you said.
Yeah, sure, but I'll not really equate, this to only, return to quality kind of comment, because there are quality companies even in mid cap and small caps. Essentially, what we're witnessing really is that there are quality companies across the curve. It is just, that the money flow was chasing far more towards the mid cap or maybe small cap end of the segment. And that adjustment is perhaps got, tilted because FPI selling started coming in. I won't really see only quality as the primary variable behind this because, there are quality companies also having come down on, on a stock price front. But it looks more like a valuation adjustment playing out. In a way, what we're witnessing right now is a classic reversal of what we would have seen in the last year first quarter. For example, look at March 24 versus what we're seeing right now. It's just nothing but in a way, a reversal of what was playing out there. So it's not really only about quality, it's also about valuation.
All right, Krishna, appreciate you joining in and filling us in with your take on the market. So thanks a lot for joining in.
Yeah.
Well, let's focus on another corporate, Cummins India. The company reported a good performance in Q3 that was led by the double-digit revenue growth. To discuss the outlook for the next fiscal, we're now joined by Shweta Arya, the Managing Director at Cummins India, from the sidelines of the Kotak KEI Chasing Growth Conference. Hi, Ms. Arya. Thanks a lot for joining in. Well, let's start off with what is your view on the domestic as well as exports market for the next couple of years? That is 2025, 2026. How do you see things panning out?
For financial year 2025 and for financial year 2026, we expect positive growth in the domestic segment, largely driven by the power generation segment, as well as some of our industrial segments and continuous growth in the aftermarket. So our anticipation is for financial year ending 2025 and financial year 2026, both the years we anticipate double-digit growth. For exports, the end market demand is still not showing a very clear trend. We have been focusing a lot in improving our channel presence, making sure our products are available. There is reach that we provide through our channel in different markets. So our efforts are continuing in that direction, yet we don't see clear demand trends from each of the different markets that we operate. So it's a mixed bag in terms of anticipation from exports in the coming financial year.
Okay, so you're saying domestic demand is looking robust, but export markets, you're still awaiting some more clarity. Another third quarter was the second quarter after transition to the new emission norms. So have things settled now? How is the overall demand environment for these CPCB4 plus gensets?
So on the ground till December of 2024, CPCB2 inventory was available. There was CPCB4 selling in the market from 1st of July 2024, but there was inventory of CPCB2 available. From January 1st, we will see across the channel in India only CPCB4 plus product. So till December, there was very good demand in the lower than 800 kilowatt hour product range, which has moved to the new emission norms of CPCB4 plus. Now we will see how this plays out. We definitely believe that there is demand in the power generation market in different segments in the ranges where CPCB4 plus is applicable.
And what about the order pipeline, Shweta? How is that shaping up? What's the kind of visibility that you have here?
These are not all long-term orders. These are short-term, shorter lead time orders. So we do not have visibility for very long-term. But as far as I can talk about today, we have a healthy order board available for the next few months.
Okay, all right. Could you tell us what is the margin trend going forward?
See, our margins, since we play across power generation, in the power generation across the ranges in low horsepower, high horsepower, medium horsepower, and then in the industrial space in segments like rail, defense, marine, oil and gas, and then the aftermarket. So our margin is a blend of all of these different segments. So in every quarter, there could be a slight change in the margins. Our endeavor is to always improve our margins. We work on cost optimization of our products to be able to provide right value to the customer. We work on improving our manufacturing operations where we can get in more efficiency and more productivity. So our efforts are in that direction. There could be a quarterly difference based on how the mix in our portfolio plays out.
Okay, all right. Well, could you help us out though with a margin range at least?
Nothing specific. Our endeavor is to grow profitably so that we manage our margins and bring in even better margin growth or even better profitable growth.
Okay, what about the competitive intensity, Ms. Arya? I mean, how is that shaping up with peers introducing their own, products in the market as well? How is the tech being received in the market for these gen sets? And are you able to command, say, better premium on your products?
I would say that we are seeing competitive intensity in the market. All our competitors have launched a full range of CPCB4 Plus product. Like I said, the switchover to CPCB4 Plus happened July 1st, 2024. There was some channel inventory available till December 2024. So we will now see how competition plays out over this quarter and the next.
Okay, so you're saying that you will see how competition plays out over this quarter and the next. So let's talk about now itself. How are your products in this priced versus the peers? Because both purchase of equipment and, from a lifetime running cost perspective, India is a very competitive market. Do you think this incremental market share would come at the cost of profitability?
We would say that we have been there in the Indian market since 1960s. We have presence, we have a formidable aftermarket presence as well. We also launched, if I were to very specifically speak about the power generation market, we launched our CPCB4 Plus product on July 1st of 2023. For the whole year of 2023-24, from July 1st, 23 till July 1st, 24, CPCB2 and CPCB4 Plus, both products were available. We did sell CPCB4 Plus products in that time frame, and that gave us a lot of advantage in terms of managing what we call initial teething issues in the product. It helped us improving the quality and reliability of our product. So I would say that definitely gives us an advantage. We were able to see the product performing in the field in that time frame.
All right, Ms. Arya, do you see any threat from BESS, that's battery energy storage systems, and other alternatives as battery costs, they've continued to decline?
In the power backup space, we believe over the longer period of time, batteries could be a possible solution. The way we see it is that our end customers will probably have different energy sources. You can have grid, you could have solar panels, you can have battery. We do see a place for gensets even in that scenario, because for a longer duration of time, providing reliable power is what gensets can do today. We need to see battery prices falling even further, and every day there is research happening in battery technology, battery prices, there are different chemistries available. As we see it today, we see gensets being a part of the overall energy solution for our customers.
Okay, got that. By the way, that's an update, interesting update coming in from BMC here in Mumbai, asking MGL for a lot of these institutions, bakeries, hotels and roadside vendors. I think they have to switch to some clean fuel. We'll try and get more details on this in a minute.
So, a lot of the bakeries in Mumbai, there are around 5,000 or so. All of them were asked to shut operations largely because they were using, so to say, unclean fuel, and that was causing a fair amount of pollution. We have been speaking about, the air quality in Mumbai, etc. And now, with them having asked to shut operations, they've now directed, the BMC has now directed to MGL saying that you have to cater to these guys as well. Is this a big business positive for MGL? Not so much, just a mild positive that, okay, these were the businesses that were affected by the BMC's direction on clean fuel, and now they've been directed, to use fuel from MGL. Yeah. Slightly incremental business positive coming in out there, but this is more environment positive than business positive. The stock has seen a bit of a recovery, but at what cost do they supply to these guys, and do they have the necessary infrastructure to supply to them or not is also the big question. We need to know the timeline and all of that as well.
And I guess a lot of the larger establishments anyway would have been, working on CNG.
So this isn't about the larger establishments. Yeah, this is about the smaller
vendors,
the roadside vendors, the roadside bakers, the unorganized lot, basically.
Yeah. So anyway, not much of a volume impact over there. But to get back to that conversation with the management of Cummins, Ms. Arya, I just want to go back to the point on exports. You said that, of course, you need more visibility in terms of demand, but there is a recovery that seems to be, visible as of now. So can you tell us which regions are doing well and which geographies are still, so to speak, struggling? What's the outlook?
For exports, it's very difficult to say that here's one geography which will really take off. We have seen in a particular quarter orders coming in from one geography and in the other quarter coming in from another geography. So still the geopolitical situation hasn't stabilized as much, and we are not seeing clear demand trends from one particular geography. Our endeavor is to improve our product availability, make sure we have fit for market products for those end markets where we are selling, and also make sure that we have the right channel partners to be able to sell our products in those end markets.
Since we're speaking about exports, can't take your eyes off what's likely in the US. Do you foresee any impact coming in from Trump's tariff policies on particularly your export business?
We are evaluating this at this point in time. It is a wait and watch situation. Not all tariffs are announced yet. We are evaluating on how it impacts which geography in which way.
All right. And is the best of your margins behind you? And I ask this specifically because you had in the conference call mentioned that, the peak of the gross margins is what you saw in the prior quarter. So the question is whether this sustains or maybe from here on it's only downhill from a margin standpoint.
So gross margins for us are a play of the product mix. Since we are present across various segments, in power gen, in industrial, and there's aftermarket, there is a segmental play there, and there is a product play there, product mix, which plays across our margins. The margin is a blended margin of all those products. And we believe that there is room for us to improve our margins because there are cost reduction efforts that are ongoing, manufacturing operational efficiencies that we are building in. So we believe that we can improve our margins.
Right.
Okay, you believe that you can improve your margins. Your shareholders will like that. So finally, the big picture questions. FY26, what is the outlook? If you can, leave us even with a guidance band of sorts, revenue. And since you're talking about margin improvement, how much? Is it a rough target you're working with?
For financial year 26, we believe that we will be able to sustain the double-digit growth from a revenue perspective. From a margin perspective, as I mentioned, it is a mix play here based on which product portfolio sells in which segment. And we continue to put in our efforts to improving our margins and delivering profitable growth.
Sure. Okay, and finally, a broader question on the industry. This whole talk about private capex. Do you see a pickup on the horizon?
We believe that with this budget being announced and 11.2 lakh crores of capital expenditure by the government is trying to draw a balance, in our view, between government capital expenditure and trying to boost private capital expenditure. We haven't seen it happening just yet, but our belief is that it will pick up in this year.
All right, take that point. Thank you, Ms. Arya, for joining in and giving us an outlook into your business on the competitive intensity and the near-term views on exports and the domestic market itself. We wish you good luck at the conference and for your business going forward as well. But just before we slip into a short break, Nigel, we were talking about 900 stocks advancing, that going down to 700. Now that's down to around 524 itself, the decliners moving all the way up to 1900. Though all is not lost, I'm looking at a couple of stocks which have seen sharp recoveries from lows. We were talking about Godfrey Phillips as, the stock of yesterday up nearly 17-18%, in this month up 50%. It opened lower, maybe on account of some profit booking, so it was lower by about 5%, and that itself has been bought into. The stock has recovered about 11% from lows, up around 3% now as we speak, and that's taken this week's gain on the stock itself up to around 21%, and this month's gain to 61%. So report good numbers, do better, and the outlook for the industry improves, the street rewards you. Whereas on the other hand, stocks that were, seeing a bit of decline, or rather seeing a bit of an up move at the open, have now been sold into. Westlife Food is one of them. At pre-open was higher, opened about 3-4% higher, and from those highs, the stock has actually corrected about 6%, currently at the low point of trade.
Okay, all right. On that note, let's quickly take a break, come back on the other side, and we will connect with Sudhir Sekri, Chairman at the Apparel Export Promotion Council, and Prerna Jhunjhunwala of Elara Capital. as there is a lot of talk on reciprocal US tariffs. So what does that mean for Indian textile and apparel exports? We discuss this with the experts. Welcome back. So the news from the market is that the Nifty is stable. It's the mid-cap index. It's continuing to nurse a cut of around 1% at this point in time, and the market breadth is still quite weak. Let's pull up the advanced decline ratio. It's the mid-cap index. Advanced decline ratio still far more many declining stocks. Let's see if this improves as the day progresses. For the time being, we're putting the spotlight on the textile and apparel sector. Of course, after US President Donald Trump has issued that executive order on reciprocal tariffs, the fear is that perhaps either India will have to reduce its own tariffs, imports coming into India, or the US is going to be increasing tariffs on many of the product categories and lines. The issue is, how does this impact big exporting sectors out of India? We discussed what happens to defense manufacturers the other day, and today we're putting the spotlight on textiles and apparel because it's a huge export industry for us. So joining us are Sudhir Sekhri, Chairman at the Apparel Export Promotion Council, and Prerna Jhunjhunwala, Vice President Equity Research at Elara Capital. Thank you very much for joining in, lady and gentlemen. And I'll start with the lady. Prerna, let's go with the numbers first. Textile exports into the US, and companies have done a phenomenal job, right? Groups like Wellspun and so many others, Gokuldas exports, whether it's textiles, terry towels, linen, apparel themselves. So India's done a phenomenal job. Now, is that whole story at risk if the US suddenly increases the tariff barrier, several fold? What are the numbers telling us? What is the export picture now?
So if you look at the US imports, India's market share in home textiles is at around 61.4%, 61.5% approximately. And for terry towels, it's around 45%. For garmenting, it's around 7% odd. So we are a big exporter to US in terms of home textiles, and we are gaining market share in the garmenting business. So it is definitely an important geography for Indian textile exports. Now, in terms of tariffs, if US puts in tariffs, there could be an impact for the cost structure that US importers will have to take into account because of the increase that happens due to tariffs. But at the same time, we'll also have to see how India can be replaced. I don't think so. Such a big geography, India can be replaced in US's imports of textiles. And where do the country finds another alternative? So all these are challenges. Textile industry is a complex supply chain wherein imports happen from multiple countries, but not one country or a few countries can satisfy other countries' demands and skill sets. So hence, we believe that, tariffs could have an impact. There could be talks with the importers, but how much and if at all tariffs comes to India in textiles, we'll have to wait and watch.
Okay, by the way, let's just pull up this table. I think we'll have it. This is a calculation done by Nomura, and it's talking about the total differential tariff. Basically, if you net off how much we're charging for US imports coming in versus what they're charging us, this is the net. So our tariffs obviously are higher, and the differential is as high as 17% in footwear. Food products, it could be 35%. Textiles, about 15.5%. Let's come to Mr. Sekhri as well. Mr. Sekhri, so isn't this a straight area of concern if the US increases tariffs. What is the blended tariff? What is the import duty one has to pay as of now for apparel exports that are going into the US?
Yeah, and as far as apparel is concerned, I don't think there's much of a concern that we have. Let me explain to you why. You've shown a difference of 15.6% in a difference of tariffs in the textile area. But when you cover apparel, just apparel, the difference is much smaller. It's to the tune of about 7%, because the import duties of garments into the US range from 2.6% to 32%, 33%, as a matter of fact. Man-made fabrics, for instance, attract duty as high as 33%. It's the cotton where the duties are lower. Now, I do agree that our exports to the USA are more in cotton fabrics, cotton garments, which forms about 65% of our total exports, whereas the other 35% is rayon or man-made fabric exports. However, if you balance it out, I think the average duty that works out is about, we're still working out the exact details, but it works out to something like 19% if you see an average, and the actual export that is being done, being made in the two categories of cotton and man-made fabric. Now, as far as import duty is concerned, import duty on apparel is 20% with a 2% surcharge. And in certain categories, of course, it goes by it's 45 rupees per piece, or 20%, whichever is higher. So if you average it out, it comes to about 24%. So not 24.5%. So if you see the differential is about 5.5 to 6%, as opposed to textiles, where it is, appears to be 15.5%. So, however, why I said that there's not much of a concern, because, if you see it pragmatically, there is a demand for Indian apparel. And if the duties go up in the US because of higher duties in India, that will affect our neighboring countries also. Our competitor, for instance, China is our biggest competitor. And China, we all know that they are being, huge duties are being imposed on China. So China is actually out of the picture when it comes to competition. They are not going to eat into our business at all. On the contrary, probably we are going to eat into their business. We'll get part of their business. Similarly, our other competition is Vietnam, Bangladesh. Bangladesh, which is in our neighborhood, they have their own problems. Their business is not, I don't see any increase in business happening there. I won't say the business will go down, but the 5 to 10% increase they were seeing annually, that is not going to happen because of the political situation over there. So, all said and done, in spite, even if our duties, the government, first of all, we don't know whether the Trump government is going to increase duties because of this slight differential. But I'm saying, even if, as a worst case scenario, even if they do, I don't see our business getting affected in any way.
All right, we take that point, and fair points made out there. The harm would be a lot more on neighboring states like Bangladesh, Vietnam, and China, who have been eating away our share of exports as well due to some of their policies, but now they're in economic doldrums. But as you were speaking briefly, the Nifty and the Sensex moved into the green. It was led by the IT pack, and it was led by HDFC Bank, pointing out that HDFC Bank has been doing well despite the weakness that we're seeing in the market. HDFC Bank at the higher end of today's trading range so far, and the IT index as well. So both these heavyweight sectors actually, contributing. Though just keep an eye out on the Nifty Bank itself, down about 1/3%. Recoveries are being sold into as well. But let's get back to our conversation with Sudhir and Prerna. Sudhir, just a follow-up on what you said. Duties being increased is one thing. The bigger differential is the cost of production. So even if the duties are increased by a certain proportion, the cost would still be a lot cheaper to import as against manufacture locally or look for other alternatives. So if you could give us a sense on, what is the cost differential between Indian products and the ones that are made by our competitors and exported to the US versus what's manufactured in the US itself. That's point number one. And secondly, with the depreciation that we've seen in the rupee, which is much more than what we've seen in some of our peers, how much does your cost advantage improve by?
Okay, let me take it one at a time. See, first of all, when we talk about the cost advantage between that Bangladesh probably has because of their low labor cost over India, that cost advantage would remain even if the duties go up and down. So that cost advantage imbalance will remain. Now, you ask the question whether the manufacturing in US, so there's hardly any manufacturing of garments in the US. Of course, there is manufacturing in South America or Latin America, but again, you know that Mr. Trump is going to impose some duties there too. So I would think that as far as duties is concerned, I think we'll have to see it separately, and because it does not really affect the cost of production. That was your first question. And what was your second question, please?
The depreciation in the rupee, how much has that been an advantage?
Well, of course, definitely, this is going to be a big advantage for exports. We've already seen a depreciation of about, 3 to 4% till now. We expect another 2-3% depreciation. And this means that obviously if I give away the entire gains that I have made to the buyers, then the buyer stands to gain 5 to 6%.
Sure.
The whole lot of money.
No, absolutely. And we have to see how these negotiations go, because the US president has very clearly said the tariff is just one piece. He's looking at a lot of other aspects, including currency, which could be making exports coming into the, or the imports coming into the US cheaper. Very quickly, Prerna, on you, I mean, from a stock perspective, as these negotiations play out, we'll only have clarity, I think, around the 2nd of April or so. Right now, the textile and apparel stocks under your coverage, are you changing any views, anything? And what are your picks? What do you like the most in the whole sector?
Among our coverage, we like Arvind Limited and KPR Mill. Given the price correction in the stocks, they look attractive at current prices. We're not changing our view as of now, as we don't know what is going to happen and what kind of tariffs would be imposed, and will there be any material impact on these stocks. So we'll maintain our positive view on these stocks.
Okay, all right. Ladies and gentlemen, thank you very much. Slightly shorter conversation, but we would definitely want to revisit the issue once we have some more clarity on the, the final tariff lines that are agreed upon between India and the US. But there's AEPC maintaining that Indian apparel exports will not be impacted. Well, with that, I think we have to quickly move on to our next guest, and we're putting the spotlight now on the IT sector. The sector, of course, has reported a mixed performance in the third quarter. So what lies ahead, and are these green shoots of demand really blossoming into full plants and maybe even trees later down the line? We have with us Kanwaljit Saluja, who's Senior Executive Director and Head of Research at Kotak Institutional Equities. And, of course, he's joining us from the sidelines of the KIE Chasing Growth Conference. Kanwaljit, thanks so much for joining in. In a market that's beaten down so badly and confidence is so low, we keep looking out to tech as some island of safety. But beyond that, that's a tactical positioning point of view. I mean, I want to start with the real growth question and what stood out for you. Before we talk about large caps, actually, let's talk about the tier 2 companies, whether, any of them really fired up your imagination.
Well, I think, what's been happening in the sector is essentially a gradual recovery. What you're going to get, in our view, in FY26 is a growth rate which will be better than FY 2025, but it will still not hit the normalized level of growth. And the reason is because the growth recovery is patchy. There are segments in the market that are doing well, which is financial services and retail. And at the same time, there is deterioration in the manufacturing vertical. Now, within this spectrum, what is happening is that some of the challengers are doing better than some of the incumbents, especially the likes of Coforge and Persistent, which seem to be firing, all guns and actually would end up reporting growth rates which will be materially better than the peers. Again, having said that, not all challenges are the same. Not all incumbents are the same. There are basically a mixed bag of performers in both the segments of the market.
Okay. We'll come to the mixed performance in a bit. But now at a headline level, now I'm talking about the traditional IT services companies, the big boys. There, Kanwaljit, what are the different trends that are emerging? Most of them, I remember the commentary, you were talking about sort of cautious optimism and seeing some improvement in demand in North America. So for FY26, what's the kind of growth in the business that you're penciling in?
I mean, see, essentially, it's a recovery. It's a very gradual recovery. It's a frustrating recovery as well. So let's say if you're penciling, if these companies would have grown by around, on an average, 4 to 4.5% in FY 2025, then at best you can pencil in 6.5 to 7% growth in FY 2026. Again, there'll be dispersion in growth rates depending on a couple of factors. One is the large deals and mega deals. I mean, there are not many of those. And second is the contribution of revenues from verticals that are in a state of recovery versus verticals that are in a state of challenge. So FY26, again, at a broader level, there will be some improvement, but within that, the dispersion in growth rates will again be there, as you saw in FY25.
All right. Hi, Kanwaljit. Nigel on this side. And good to have you on the show after a while. The argument is that global IT peers, where you look at Cognizant, you look at Accenture, they're trading at relatively cheaper multiples in comparison to what our Indian companies trade at. Could you tell us your comment on that? Justified? How does it shape up?
Accenture, I think the valuations have almost converged with Infy and TCS. Cognizant, you cannot compare on valuation because the growth rates are lower and the company is in a turnaround phase. So, so to that extent, there are not enough number of global services companies for comparison. But when it comes to specific, it's just the factors that I just laid out.
Right. You spoke about valuations converging with TCS and Infosys for some of these companies, but TCS, which is up only 3% in the last 3 years, has been an underperformer. It's one of your top picks, and you do acknowledge that, it'll be difficult for the company to backfill the loss of revenue from the BSNL deal in FY26. What makes you still bullish on TCS?
The BSNL deal does not change the EPS, right? It's a zero margin deal. So the only thing is that the top line becomes lighter, the margins go up, your EPS growth will still be around 9 to 10%, yeah. So think about BSNL as empty calories for now, yeah.
Okay.
Empty calories, okay. Usually we try and avoid them, but then again. So, to go back to the point, and I'm just simply asking from a, portfolio positioning point of view, are you better off, if someone has to allocate fresh capital to Indian IT, are you better off being with the safety of the likes of TCS or Infosys, or should you look at, Coforge and Persistent, the companies that have been showing growth, or should you go to the third leg, which is some of these ER&D companies like KPIT Tech, Tata Elxsi? They've had a bit of a rough ride last few quarters. Do you see that, also recovering? Where to put the money in IT?
Okay, so I'll give you a boring answer. First of all, for the time being, avoid engineering services because there are headwinds in engineering services across multiple segments, whether in autos, whether it's in high tech, etc. So I would avoid engineering services. When it comes to between the incumbents and challengers, there has to be some fun, right? And there has to be what I would say, some sugar as well, rush as well in names like Persistent and Coforge. So you end up buying. I will recommend Coforge because the growth will be turbocharged, far better than what basically the street is building in. 20% plus organic growth in FY 2026. The stock has come off, so we'd recommend Coforge. And Infy and TCS, one can basically pick any of them at the current levels. I'll just say that Infosys nudges ahead purely because they have a higher discretionary exposure, and the base assumption is that in FY26, discretionary spending will recover. Then maybe the growth rates will end up being better in Infosys. So Infosys, Coforge, you pick one. From each category.
Kanwaljit, you're really whetting our appetite this morning,
huh? If you want to have a wider portfolio.
Yes, go on. I'm saying you were really whetting our appetite with the empty calories and a little bit of sugar rush with Coforge and then Infosys. But please complete the point. You're saying maybe Infosys can edge ahead on the growth. But please complete.
No, but if you want to basically have a well-balanced, rounded portfolio, have Infi, have TCS, have have Coforge. There's a turnaround play in the form of TechM, which seems to be forgotten. So there are plenty of options to look at in IT services. Yeah.
Okay, but no ER&D. We remember that point as well, because engineering in some of those sectors like autos still perhaps the recovery is still some time away.
We have some, absolutely. I mean, some good companies, but unfortunately, the macro environment is fairly challenging for them. But there's some very good companies in the space over there.
Thank you so much for joining in. The basic idea is a balanced diet and a balanced portfolio. Use the macros right with Infosys, TCS, and TechM, maybe a bit of sugar rush in terms of Coforge as well, but no more than that. Thank you for joining in and wish you a good conference as well. With that, let's go back to Nigel, who's standing by at the wall to talk us through the market outlook from top voices of few brokerage houses. Over to you, Nigel.
Well, let's get you what the top voices are saying. Rhythm Desai of Morgan Stanley, well, he says that Q3 earnings growth was up sequentially, which was better than the subdued expectations. He goes on to add that the market looks good in the near term and we could be in for a near-term bottom, given that improving growth. If global cues do not surprise negatively, he adds that India should resume its outperformance in comparison to the emerging markets, and that could be rather soon. They're overweight on a few stocks, which include L&T, Bajaj Finance, ICICI Bank, Mahindra & Mahindra, Titan, Trent, Maruti. While they're underweight on Eicher Motors, RBL Bank, Wipro, Concord. So that's about Morgan Stanley and his stake. Moving to Surendra Goel of Citi, he says that the headline trends in Q3, they missed expectations with EBITDA growth of just 7% on a year-on-year basis. But he goes on to add that with a pickup in central government capex in the past few months, the budgetary support to the consumption space and also the start of rate cuts, he expects growth to pick up. But also goes on to add that the impact of the reciprocal tariffs from the United States will be something that could impact select sectors. After a decline of 12%, well, valuations at around 19 times 1 year forward is below the 5-year long-term averages. And the FIs, well, they're underweight on the benchmark, which is the highest that they've seen in the last 15 years. He winds down by saying that India looks relatively well placed post the correction, and their December 2025 Nifty target is 26,000. Moving to Rajiv Batra of JP Morgan, he says that Q3 was another subdued quarter with regard to earnings growth, which was driven by moderation in urban consumption, tighter liquidity, a depreciating rupee, and also the rise in input costs. But now they expect a nascent recovery in Q4 earnings on a sequential basis, and that's because of sustained upswing in rural demand, a rise in government spending, and also lower raw material costs. They add that despite the recent earnings downgrades, consensus expectations for calendar year 25 as well as 26 are still elevated, and that's why there could be further downgrades specifically in energy, materials, industrials, as well as passenger vehicle plays. They reiterate, though, their overweight stance on financials, consumer staples, consumer discretionary healthcare, as well as real estate. But let's wind this down then with a technical call coming in from Lawrence Blanco of CLSA. And he's particularly commenting on the dollar index. He says that the dollar index is strengthening the 103 support, though in the past 3 months, the US dollar index has been capped at around that 109.8 to around 110.18. And they found some kind of support in this vicinity of around 106, 107 area. A break below this mark of 106, 107 support would suggest that December's breakout, from that 2022 to around 2024 trading range was not genuine one, leaving the dollar index could head back to around that 99 to around 100 mark to that zone of around 106, 107 trading range. Within the old range, the 200 EMA offers some kind of support, the near-term support at around 104.8 area. So that's what all the top voices are saying with regard to the Indian markets, as well as Lawrence Blanco winding it up with the technicals.
All right, we take that point. Nigel, Lawrence Blanco winding it down with the technicals. So what we'll do is we'll wind this segment down, take a break, come back. On the other side, we'll have more technical trades coming in from Mitesh Thakkar and Sudarshan Sukhani. Coming back, recoveries are being sold into. Now the mid-cap index down about 0.75%. Look at Zentek. It's locked in 10% lower circuit, despite the management saying that they will meet the 900 crore revenue guidance with 35% margins as well. So the street is in the mood of, taking money off. The promoters said that they have no intent of buying in the open market right now. And then we are seeing some decline in a bunch of other stocks as well. So, Jubilant Pharmova, lower at the day's low, Hindware Home, among others are, selling off. And Strides Pharma from the frontline F&O stocks also at the low point of trade. Let's go across to Mitesh Thakkar now. Mitesh, your trade's at 10. What do you have on your list?
I have one buy and one sell call. On the selling side is Ambuja Cement with a stop at about 487 for targets of 460. And Kotak Bank is a buy. Keep a stop below levels of 1930 here and look for target of around 1995 to 30.
Okay, all right. Mitesh, thanks for those trades. We will come back to you later in the course of the day. Right now, another quick break. Market's still down about 45 points in the Nifty. Back with some moving stocks in just a bit. Welcome back. Let's focus on a couple of stocks that are in news this morning. MGL is reacting to that update that was flashing on the screens just a while back, which basically deals with BMC issuing a sort of directive saying that all the smaller, perhaps street side vendors, etc., operating in Mumbai, they need to switch to clean fuel. Now, what exactly does this mean? And is it material at all for the company? Let's ask Sudarshan. Sud, what's happening here?
The reason the stock of MGL is in focus because Mumbai Municipal Corporation, or say BMC, has issued directions to all the roadside vendors or say eateries or dhabas to shift to clean or eco-friendly fuel. And it's categorically saying that either adopt CNG or PNG instead of polluting fuels. And it's on the back of the recently High Court orders saying, basically High Court had issued directions to BMC to ensure that all these dhabas, it is shift to these fuels and in a specific timeline. So now BMC has to come out issuing directions to these eateries, dhabas to shift to this clean and eco-friendly fuel, and the deadline is given is of July 8. And BMC also has issued notices to more than 84 restaurants and eateries and dhabas in Lower Parel and Prabhat Devi, and it says licenses will be marked as not to renew until the transition is completed. Also, no new licenses will be issued to establishments using conventional fuels if these eateries and dhabas don't shift to eco-friendly fuel by July 8. So it's important for MGL because it's the biggest player in the city as far as the clean fuel or say CNG or PNG is concerned.
All right, it is good news for MGL in terms of business opportunities, Sudarshan, but all of us here are tempted to ask you, which is your favorite dhaba or eatery in the city?
I don't stay in town, so I stay in Dombivli, so I can't talk about it.
You work here, you work in Worli, you work in Lower Parel.
No, I don't have any favorite.
So Darshan likes his
He's a healthy guy. He has green tea and he only has his high-protein diet. Home food is the best. There we go. All right, Sudarshan. Thank you so much. Well, let's quickly move on. I think we have another management in focus.
Well,
Rallis
that's
India.
right. Rallis, that's the one on our radar. It was a challenging quarter 3 for them. The company did report some kind of weakness, both in pricing, exports as well. They saw a degrowth in revenue due to a significant fall, in fact, in exports. My colleague Vamakshi caught up with the MD and CEO, Mr. Shukla, from the sidelines of the Kotak Chasing Growth conference and began by asking the reasons behind the slowdown. Let's listen in.
When you look at Rallis, I think it is very important to understand Rallis operates in multiple segments. One of our businesses is domestic and then export. On domestic, we have crop protection business, we have biological business as well as seeds business. So when you look at performance of biologicals and seed business, I think they have done very well. Even on crop protection side, domestic business has done very well. On volumes, we are up. Obviously, industry is going through a very difficult phase where prices remain subdued. As a result, performance may not exactly be what it looks like in the number. Our biggest challenge has been export market, where global commodity prices are low. We are also dealing with some of the legacy product where because of the excess demand supply situation, prices and volume both are subdued.
All right, but what is your outlook going forward when it comes to the volumes as well as the pricing? Because even though the domestic business has grown by 2.5%, the pricing over here has still declined. Similar is for the exports business, where we're seeing both a 34% volume decline as well as a 4% price decline. So going ahead, do you think the decline in volumes and the declining in prices will continue, or have prices stabilized now?
So global situation still remains very challenging, where commodity prices are low, farmer earnings are still low. As a result, and we are also stuck with the what you call legacy portfolio. So global business, I think we have seen the bottom. Things should only look better from here. But you have to understand our business. It's a very seasonal business. It is very, very difficult to judge rallies based on the quarter, because these quarters overlap from Kharif, Rabi to different seasons. What I want to tell that our company is going through a transformation process. We have identified some gaps, and we are trying to work on those. For example, we believe our seed and biologicals portfolio can do better from here. That's a area which is growing. We are focusing a lot on that. Within the crop protection portfolio, we had weakness in the herbicide business. We are fixing on that. I also believe the efforts we are taking on the demand generation side to get more focused on the domestic market should also start giving us volume momentum. Prices, of course, I cannot control, because prices are driven by what happens based on the global demand and supply situation.
Well, so you're saying that volumes, the degrowth that we've seen, that is going to end now, especially on the exports part. Now, from now onwards, if we compare on a quarter-on-quarter basis, it's going to improve. Is that what you're saying?
Well, based on the orders we have and based on the conversation we are having with the customers, looks like while prices continue to remain low, but volume certainly should start picking up.
Sure, that's quite promising. And, briefly, you mentioned about how you're changing, so now you actually had planned a portfolio cleanup as well as a leaner organization structure. So I wanted to ask you, is the churn in the product portfolio, at least, is it largely through? And another question on that front is, when will the benefits of this start flowing through, and how will it exactly impact your own profitability?
So our focus remains to improve profitability. We are in a seasonal business. We get only one chance in a year to sell to the customer. But some of the efforts we are taking in terms of making our organizational structure leaner, trying to pivot more on the customer, leveraging digital, also cleaning up the portfolio. We have recently evaluated and done with the exercise of looking at the tail portfolio. We are certainly going to deal with as we enter into the new season in 2025-26.
And what would the improvement on the profitability be on account of this sort of restructuring?
So it's very difficult for me to give you a short-term projection, but our long-term goal is that on a continuous basis, we should improve our return on capital employed. And it has to come from combination of portfolio mix. So we need to start weeding out low margin portfolio, start adding in more higher margin portfolio. On the cost side also, we are looking at how do we utilize our assets better, at the same time manage some of our costs differently, so that the cost we incur, it is being used for more productive uses, for example, demand generation activities, etc.
All right. So when you're talking about adding more better margin products to your portfolio, you've also mentioned about metalaxyl. So it is, I think, in the final stages of being commercialized. So when will that commercialization take place? And is this a part of the products that you're talking about? And apart from this, what other products are in the pipeline that could probably, help your margin expansion plans as well? And, quantify for us the long-term potential that you see from these newer products that you plan to introduce.
So the way we look at it, our crop protection portfolio, I think we expect our herbicide, for example, herbicide as a part of crop protection contributes lowest in the overall crop protection portfolio. In domestic contribution of that should accelerate. On the seed side, we should actually accelerate our business. I think this business we had bought 12 years ago, it is now showing sign of improvement. Similarly, on the biological portfolio, I expect high double-digit growth in the years to come.
All right, and just one more question on the margin front. Your EBITDA margin was under pressure in the third quarter, despite the improvement that we saw in the gross margins. Now, you mentioned that pricing did decline in Q3. So where is the improvement in gross margins coming from?
So improvement gross margin is always a factor of product mix. As I said, we have seed business, biological business, domestic crop protection business, as well as export business. Because there was a lower export business, which is a low margin business, that has led to overall margin improvement. But we expect that business to remain under challenge because of the global demand supply situation. But we expect to continue to improve our margin on the domestic side.
Sure. Thank you so much. And one last question from my end. For FY26, what could your revenue as well as margin profile look like? If you can just give, if not specific numbers, but at least something qualitatively.
See, our effort in the what you call five-year horizon is going to be that we start growing faster than the industry average. Industry grows about 5 to 7%. Our effort will be to really grow faster than the industry. But more importantly, I'm expecting significant improvement on return on capital with the combination of portfolio adjustment as well as some of the cost-cutting measures we take. So I expect at least 500 basis point margin improvement in next 4 to 5 years.